on how to do something. There's general agreement in the industry. But there are also a lot of issues where there is not agreement. And even in the United States, where we like to think that this is a fairly mature industry, we still have our disagreements about how a lot of different topics in valuation are handled. And one of those that I'd like to speak about for a bit, and I'm going to set my timer so I am sure that I leave time for questions, is the topic of premiums, particularly control premiums. So before I begin on that, I want to make sure that you understand what I mean by control premiums. What I'm referring to is the idea that an investor in a business, someone who's looking to acquire a business, might find the idea of owning the business or a part of the business and having rights of control, being able to dictate the policy of the company and elect the board and basically have a say in the business, that has value. That if I was faced with that investment, I might pay more for it than if I had an opportunity to invest in a company without those rights. I still would have economic benefits, but I would not have those powers or rights of control. In that case, I might pay a lower price. So the idea here, the premise of this is that there might be a difference in value to an investor who's acquiring a small interest in a company without rights of control. We might call that a minority interest or a non-controlling interest, versus an investor who might buy an interest in a company where they have 100% control, the ability to make changes. So those aspects of control have long been a deep discussion in valuation, and for many years we thought we had agreement on that topic, and we taught ourselves and we've taught others to treat that difference between the non-controlling value and the minority value as significant and very and to be measured and determined by, for example, the application of a premium. And so one of the things I want to do is explain sort of the way we used to do that, but also the fact that the thinking on that has evolved. And this has a relevance to CPAs, not only if you are performing valuations, but if you are using or reviewing valuations as well. So the CPAs in the United States, for example, spend a lot of time reviewing appraisals, reviewing valuations. When we do valuations for financial reporting, under GAAP, of course, not IFRS, but the same principle applies. The auditor, the CPA, needs to review that valuation and make sure that it is reasonably done, it follows standards, and it reflects best practices. So this topic pertains to a change in best practices, effectively. And it's important to the CPAs because many of the valuations for financial reporting are performed on a control basis, meaning the valuer is attempting to determine the value of the company as if it was the entire company, the entire assemblage of assets. For example, for goodwill impairment, or for some other beginnings of a purchase price allocation, a lot of the valuation that drives financial reporting valuations in the US. We call that first part of that valuation the step one, where the business enterprise is valued, and that's on a control basis because it's the whole enterprise. So I mentioned the underlying premise of this idea, which is that investors value control. Investors like control. They want to control their investments. They want to have a say in how things go. And because of that, they will pay a higher price. So we start with this idea that the value of a controlling interest in a company is probably worth more than if that control is not there. The question then becomes, in a valuation project, how do we measure that? How do we how much value do we place on that? And the other question, of course, is that control already in the value that we have determined, or do we need to increase the value to put it on a control basis? So there's a term that I don't like it. I understand it translates, but we use it often in the United States to describe control, and that's the word prerogatives, meaning the rights or the factors of control that the investor might enjoy. And I wanted to just mention what we generally think of those to be, so we have a common idea about what we're referring to here as control prerogatives. So it might be the right to choose the management team of the company. It might be the right to vote the stock of the company, to approve a transaction, a sale of the assets, or a transaction where another company where I'm going to buy another company. Or really, it's the right to vote the stock for any matter that is submitted to the stockholders for a vote. It could be the right to direct the company into which lines of business it will operate. And the list goes on and on and on. But those are the type of prerogatives that we are speaking about when we imagine what a control investor would be considering to be the benefits in a certain corporation of having control. Another framework that's important to understand here about control is that we have control might come in different forms. Generally, under IFRS or GAAP, when we're speaking of the definition of value, and it's different words. Here it's market value, and in the U.S. it's fair value, but the meaning is relatively the same, largely the same, almost identical. And it is that we're trying to capture the value that would occur between a hypothetical buyer who wants to buy something at a low price, of course, and a hypothetical seller who wants to sell the asset at a high price. And we don't know who they are. They are hypothetical parties. We don't assume any identity to them. But we assume that they both have the same information and that they will act rationally and without compulsion, without being forced to undertake the transaction. And they will negotiate and eventually reach an agreement, and that represents the estimate of market value. So because we don't assume the identity of the buyer or the seller, and in this case particularly the buyer, because of that assumption of hypothetical nature, we cannot assume that the buyer has any special attributes that would make the target company, the subject company, more valuable to them. So every company, has unique value, and there might be one special buyer out there who would pay a price that is above the market price, above what anyone else would pay, because the target company has special or unique value to them. And we call that strategic value or investment value. It's not market value. It's different. So I don't know, other than Muaf, I'm not sure if anyone here has been in one of my courses. I don't think so. But the example I use often is when Facebook purchased WhatsApp. And WhatsApp had no revenues. But for some reason, Facebook paid, I think, almost $18 billion US for a business that, by any other measure, had a very small value. It had good technology, and it had a lot of users, but it had no revenues. Clearly, it had no income. So by any by any measure, whether comparison to public companies or valuation of its assets or even valuation of its future cash flows, it had a modest value. But Facebook paid $18 billion because Facebook was a buyer that had a unique interest. It was a special buyer that paid a synergistic price. So that defines a form of value that we would generally call strategic value. That is not what market value is trying to measure. Market value is trying to measure what this is not too literal, but effectively market value is trying to measure what a financial buyer would pay. Meaning someone who doesn't have that special, unique, synergistic interest, but only wants to make a reasonable return on their investment, a market return on their investment, which could be a very high return in a risky company. So it's not solely that they want to earn a modest investment. They want to earn a return that is commensurate with the risk they are taking. Market value. So that market value on a control basis, we'll just call that financial control. Okay. The way that, so that's all background. That everything I've said there is sort of background to the point. Now the way that appraisers I was trained to do this, and I've obviously trained a lot of people as well to do this, is that the way to value a control interest in a company, or to value a company on a control basis, is to first perform a valuation, determine that value of that business, and then add a premium to reflect control. It was always add a control premium, add a control premium. And those premiums could be as much as 25%. So that was done with little thought to why is this business worth more, 25% even more, on a control basis relative to the non-control value. And so hold that thought. Let me tell you briefly how we generally determined that 25% or so. We would look to the public markets, particularly the US, but I think in any public market, a stock may trade at a certain price, and the next day an acquisition offer is made. And that acquisition offer, if the stock trades here, often the acquisition offer is at a premium. The buyer offers a premium to acquire all of the shares, take it off the market, and own it as a private company. And over many, many years of tracking those transactions and the premiums paid, they tend to average 35% or so, which is very big. If you are lucky enough to have owned a publicly traded stock that is acquired at a nice premium, it's fantastic, right? You can make 3 or 4 years worth of returns, maybe 10 years of returns all at once in a day. Which is why the concept of insider trading emerges, right? How great to own that stock on the rumor that it's about to be acquired, which of course is illegal, but that's why that's such a tempting thing for a unethical investor to do. So we measure those premiums in the public markets, and we say, oh, they tend to average 30 to 40%. Now we acknowledge that many of those transactions were strategic buyers. There were buyers that had a special interest, like Facebook and WhatsApp. They have a unique interest in this asset, and so we say, maybe that's why they paid so much. And so therefore, maybe we should adjust that premium down a little bit. And that's where I took my example of, say, 20 or 25%. But we would take, but the summary of that public market example is that's where we developed our evidence for the logic of applying a 20 or 25% control premium in every control valuation. And as we continue to think about these issues, and that's one of the great things about valuation, is there's no end to the opportunity to look deeper and deeper into these issues. It's a silly analogy, but it's like an onion, right? We teach this body of knowledge, but every year you can take another layer off, and there's more to it, and there's more to it. So the nuances are very deep, and that's frankly what makes it fun and intellectually challenging and stimulating. There's always more to learn. So there was more to learn about that market evidence, in fact. And when people considered the fact that we were relying on that premium, they recognized a couple problems with that. For example, number one, we recognized pretty early, which was maybe those premiums that we see in the public market are for more than just control, synergies. Or maybe, for example, the public company that was acquired, maybe it was just undervalued. Maybe someone paid a high premium, not because they were paying a premium, but because the market wasn't valuing the company accurately to start with. Understand? I personally think that was probably a very big piece of it. Other factors would be that maybe in public companies, control isn't really very important to investors, right? If I, for example, if I invest $10,000 in Walmart in the United States, I'm not making that investment with any expectation of controlling the company, right? Even if I invested $10 million or $100 million, inshallah, right? Not happening. But if I did, I would still not have enough shares to have any aspect of control over the company. So maybe our expectations of these of these minority stocks in the public market, it was wrong that we were thinking they were minority interests. But the fact is that investors probably buy stocks in the public markets, not to influence the companies, but to have the other attribute that those companies bring, which is liquidity, right? The ability to get out of the investment very fast is probably all the control I want about my investments in the public market. So there's a lot of other factors, but the conclusion that we reached about those public investments was that that's probably not the right basis by which to be assuming that if all the public companies are being acquired, if a small number of public companies are being acquired at a 30% premium, that doesn't mean every private company has a control value that's 30% higher than its minority value. So putting that public market evidence aside, the other logical conclusion people have developed about valuing private companies is that the reason any investor might pay a premium price for that company would have to be justified by some form of return on their investment. There's no value in control per se, no value in control itself. There's value in realizing enhanced benefits or enhanced cash flows from exercising control. So we've probably wrongly thought too much of control itself as driving value, just the fact that I have control doesn't make an investment more valuable. What might make that control investment more valuable is that either I can exercise my control and increase the cash flows or decrease the risk, right? If I can't do one of those two things, why would I pay a higher price for this company? I would simply be lowering my rate of return by paying a higher price. So there's some people in the US who have been saying that since 1990, my first year in valuation. And it took a long time for the rest of us to hear them and to accept sometimes these things take a long time to change. But it has changed. And it started, frankly, with the valuations done for financial reporting. And now it's spreading throughout the rest of the valuation world in the US. So what has changed is the way we think about control. So that means now, how do we think about the new way that this control level valuation is done? So let me set another stage here about this. The idea of valuing a whole company on a control basis, previously we assumed that it was the market inputs that would make a valuation on a control basis. So for example, we assumed it was the multiple that we observed from the marketplace. And we observed in an income-based approach, we assumed it was the discount rate that would make a valuation number, the conclusion, either minority or control. And the way the thinking has developed on that, resulting from the factors just discussed, is that we now think of that framework as it is the cash flows of the company that cause a valuation to be on a minority basis or a control basis. So the simple conclusion from that I wouldn't say 100% of valuers in the US agree with, but it's getting close. It's spreading like a good disease. It's a benefit, but it takes a while, and people are reluctant to change. But the thinking now is that it's the cash flows. So for example, in a simple sense, if I value a company using cash flows that reflect control adjustments, the benefits of control, I have resulted in a control value. On the other hand, if I value a business using non-controlling cash flows, the cash flows that are expected to be enjoyed by the minority investor, I've resulted in a minority value. Okay? So let me make sure I'm covering everything in the right order. Good. So now that we accept that it is the cash flows that make the difference, and not simply this quantitative premium should be applied in every circumstance, sort of thoughtlessly. We did it thoughtlessly, not that we didn't think about how big of a premium, 10%, 20%, 30%, but we didn't really stop and think, is a premium needed at all? And that's what we were thinking about now. And with the focus on cash flows, the way the thinking changes is that if we're trying to value a control interest, which we typically are for financial reporting, we stop and we first need to, we pay less attention to the market evidence of control premiums, and the focus of our analysis becomes the subject company's cash flows, and trying to determine if those cash flows reflect the perspective of a minority, non-controlling investor, or a control investor. So let me explain how those might be different. the obvious example we use in class a lot would be the example of a company, a non-listed company, where the CEO pays themselves, the CEO is the owner, and that CEO pays themselves a salary that is well above what the market demands. So that CEO, good for him, but he pays himself $2 million US, and he could be replaced with an equally competent CEO for $1 million. So we have excess compensation. There's an owner's discretionary expense of an extra $1 million of compensation. That makes the earnings lower because of that compensation. And so if that company is to be valued on a minority basis, meaning for some reason I'm valuing a 10% interest in that company, I would recognize that a 10% interest holder doesn't have the power to tell the CEO to change his compensation. The 10% holder needs to accept that as the reality of the business they are investing in. And as a result, let's assume that makes the earnings of the business $5 million. $5 million reflects that the CEO pays himself a salary of $2 million. Fine. That's the reality. And if I was that minority investor or a valuer valuing that minority investor's 10% block, it would be appropriate for me to capitalize, to view the company with $5 million of earnings. On the other hand, if I was to look at this company from the perspective of a control investor, one who's coming in with an intent to, or the perspective of the valuation is an investor buying 100% of the stock, that investor would clearly have the ability to change that CEO's compensation. In fact, when that CEO sold the company, they probably would retire. And so the new owner would need to bring in a new CEO and pay them a market salary. And that market salary would be $1 million, resulting in the earnings going from 5 to 6 because of the difference in the salary. So in my example, the minority cash flows, the cash flows expected to be received by a minority investor are $5 million. The cash flows to the perspective of a control investor are $6 million. In this example, which is far overly simplistic, control in this company is expressed in the form of $1 million of expected higher cash flows or income. So if I want to value the business on a control basis, I would not use $5 million of cash flow, determine a value, and then add a premium observed from the public markets. That would be very indirect and imprecise. Instead, I should just capitalize a company. I should capitalize $6 million of cash flows. And if I do that, I have valued the control cash flows. And no further premium is necessary, right? I've already captured control. And under my simple assumption, there's nothing more I can do as the control owner to improve the cash flows. So why would I apply a premium? Why would I somehow volunteer to pay more than my expected cash flows? So a simple example, there's lots of other examples of how a control owner might expect enhanced cash flows. Question?
A few examples, but the will be buying at discount of 2%. If we take 1 million, compare it to 5 million, which is 20%.
Yes.
If I'm buying at 10%, so actually I'm buying at 12. What I pay for the 10%, then I'm buying for 12 if the CEO has gone or retired or whatever. So I have an increase of 2%, which is I buy it at discount. That's all. Is this thinking right or not? I don't know.
Well,
But this is what I feel.
So I think the question was oriented around the continued perspective of the 10% stockholder.
Yeah.
But remember, in my example, if I'm looking at the company with 6 million of earnings, that's a control perspective. The 10% stockholder is not going to look at the company. There's my timer, so your question was at the perfect time. The 10% stockholder, or the person who's interested in buying a 10% interest, it would not be reasonable for them to assume that they can change that CEO's compensation. So I don't think that the change in the value, which yes, from 5 million to 6 million is a 20% increase, so it would in theory be a 20% premium. But I don't think the minority investor would consider paying that premium. Only the control investor who buys the whole company has the power to change that person's salary. So the idea here would be the control investment has a high value, but the minority investor would value the business based on 5 million of earnings only. Okay? Yes?
In that simple example where we have changed the cash flow, expected future cash flow, when we do that change, it affects so many things. It affects cash available for CapEx, cash needed for borrowing,
Right.
and also maybe the discount rate because of the risk profile have changed. All of that can't be translated to something to be said like, yes, there is a change in cash flow of 20%. Yes, the premium is 20% on the price level.
Right.
That's not straightforward.
So his point is that, I think your point is I made an example that is unrealistically simple. That if the CEO was to, if I was to buy the company and I was to replace the CEO and hire someone else with a $1 million lower salary, other factors will change, and I agree 100%. One of the core things about valuation that I find people don't often understand, and particularly judges don't understand, is that you cannot change one variable in a valuation and expect everything else to stay the same. There's a butterfly effect you may have heard of, or a ripple effect. You know, when a butterfly flaps its wings over here in the U.S., you know, something changes in Saudi. It's the idea that it has a trickle-out effect, and that's absolutely right. Taxes would change. Maybe the new CEO doesn't have the same strategy, and you know, the whole business strategy changes. There will always be more to it, but I think the focus still can be said that the idea, the shift in thinking now is that if one, and I think the takeaway for CPAs is, if you are reviewing or performing a control valuation, the focus of the analysis and the control aspect should be focused on how the control owner might be able to have expected higher cash flows or lower risk relative to this perspective of a minority holder. So I'll use two examples. Well, I gave you one example of where there would be higher cash flows in a control situation, which would result then, when capitalized, in a higher value. And the value would roughly be 20% higher. But the issue here, the point is, we didn't get there by just increasing the value 20%. We got there by finding a realistic opportunity for a control investor to make improvements and realize higher cash flows. Okay? Now that's a perfectly fine example, very simplified. Another example that I find very common in my work is the privately held company that is run by a manager who is not the owner, a CEO not the owner. So we can reasonably assume they are paid market compensation. And the company does not have unnecessary or discretionary expenses. It's run efficiently. It's not listed, but it's run like a listed company. It has good corporate governance. The ownership is separate than the management. Probably has an independent board. And one of the very important factors is it's already earning margins that are attractive, that are as good or better as peers in the industry. So it's got average to better than average margins for its industry. If I'm valuing that company, and I'm valuing it on a control basis for financial reporting purposes, I have to stop and ask myself, is any premium appropriate here at all? So there's no room for a management compensation adjustment. There's no unusual